The next big political event, of course, is the USA election, and while it seems that Hillary Clinton and the Democrats are pulling ahead, it doesn't make sense to us to either A, predict the outcome of this election, or indeed to completely disinvest from the USA. The USA is a big market with many attractive stocks, and rather than completely take the USA out of the portfolio, what we thought we'd do is try and identify some themes or tailwinds that will benefit companies regardless of who wins and walks into the White House in January of 2017. The three themes we've identified are as follows. The first is that US interest rates will begin to normalize, by which we mean that longer rates will become meaningfully higher than shorter rates. That's called a positive yield curve. And that will benefit banks, particularly US banks, which have been well capitalized in the last 5 to 6 years. The additional tailwind for US banks is that the European banking system is in such a mess that the investment banking departments of the non-fee income parts of European banks are increasingly unable to cope and compete with the USA banks. And so we think this is a double whammy that's going to benefit US banks. Their net interest margins will grow, their non-fee income part will grow. We like the USA banks, and we own 3 of them currently in the portfolio. The second theme that we think is going to continue regardless of who wins in the White House is going to be that of technology. Technology is everywhere and increasingly in everything. We own technology companies in the hard and software space, and increasingly telecom companies like Verizon are moving into technology. Even GlaxoSmithKline, the pharmaceutical business, has recently announced a joint venture with Alphabet, the parent company of Google, to explore the development of miniature devices or implants that can help modify the electrical signals sent down the body, which is to do with pain reduction and pain removal. So technology is something that we think is going to continue regardless of who's in the White House. The third theme is that of infrastructure. Anyone who's been to the USA or read anything about the USA will know that the infrastructure spend in the USA is in drastic need of increasing. The US highway system was built in the 1950s. There's not been a new airport in the USA for 20 odd years. The population has grown by hundreds of millions of people. And you can't underinvest in infrastructure and expect productivity in the economy to function efficiently. It's not a new theme, but having visited the USA twice in the last 6 months, in December and May, and speaking to a number of contacts that I've made there in my time, I spent 12 years in the USA, it appears to me that there's now increasingly a political will to develop infrastructure, roads, railways, bridges, and schools. And the USA will need to spend at least $2.5 trillion to merely catch up with the infrastructure spend that hasn't been made in the last 25 or 30 years. And we show a chart of how little infrastructure investment there has been in many of the Western European countries as well as the USA. Spending has to go up, and the attractions, of course, of a fiscal spend like this is that it helps to pick up some of the slack that's been left by the zero interest rate policy that we don't think has worked particularly well. So an infrastructure spend, while not a new theme, and certainly Congress could get in the way, the political system in the US can block what appear to be sensible investment policies, we think this time it is going to be different. The stock we like for infrastructure spend is a company called Vinci, which happens to be quoted in Paris, the French stock market, but actually is a global construction company with increasing operations internationally. It has not just construction business, but also has stable utility-type businesses which come from operating airports and toll roads. And so the company has a revenue stream that is very stable, where the lumpy construction work, which may or may not come in on time, is to some extent matched by and diversified by its stable revenue stream from running toll roads, car parks, and airports. This company is an attractive company trading in the low-digit PE multiples, and you can see from the attached slide that it has a number of attributes which we like. It has good value, strong momentum, and reasonably high earnings quality. It represents a meaningful position in the portfolio. We're also working on looking at other companies in the construction space, and we think that this is going to be a multi-year theme that will run in the USA and indeed throughout Western Europe. Thanks for listening.